Caledonia Mining. I'll draw your attention to our disclaimer, which you can read at your leisure. I think there's also a general one from shares as well. So Caledonia Mining is a gold mining business. We are a Zimbabwean business. We have a gold mine south of Bulawayo called the Blanket Gold Mine, which we've owned since 2006. It's been a very, very profitable investment for our business. We're a Jersey domiciled business, and we're listed on AIM, the TSX, and we're in the process, just announced this morning, I think, of applying for a listing on the NYSE MKT as well, which we think is going to give us some improved liquidity to the business. We have a strong balance sheet. We've got no debt and just under $12 million in the bank at our last quarter. The mine itself produced 50,000 ounces last year at an all-in cost of $912 an ounce. This year we're guiding between 52 and 57. We'll probably get somewhere in the middle of that, and we're guiding all-in costs between 810 and 850, sorry. And we're in the process of growing production. So we're targeting 80,000 ounces by 2021. We did 40,000 ounces in 2015. We did 50,000 ounces in 2016. We're doing another 10% increase probably in 2017, and we're gradually growing the business to 80,000 ounces. And that will get our costs down to somewhere between $700 and $800 an ounce all in. And we pay a dividend. So the yield's currently about 4.5%. We've been paying a dividend, I think, since 2012. So it's been quite a healthy return for our shareholders over time. So Zimbabwe, the majority of the questions we get at forums like this are not really about the quality of the asset. They relate to Zimbabwe and how we handle doing business in the country. So we like to deal with that issue head on. Say from the outset, we're very comfortable doing business in Zimbabwe. It's been a fantastic investment for us when we bought this mine in 2007. It was when inflation was running very, very high. Kinross were exiting from the country, and it was an investing against the tide moment for us, but it's been a very, very profitable investment for our shareholders. And certainly we found it a very comfortable place to do business. We have everything we need to operate a mine in Zimbabwe. We have very well-qualified people. We have grid power. We have tarred roads all the way up to the mine gate. We are an hour's flight and a 3-hour drive from Johannesburg. If needs be, we can get critical spares in the back of a truck and transport them to the mine in 24 hours. We've done that in the past. These type of gold mines don't depend very heavily on large-scale infrastructure, pipelines, railway lines, etc. They are essentially, we often joke and say we could put a month's production in a briefcase if we wanted to. I mean, we don't do that. We transport it a bit more carefully. But it's important to just realize that small-scale gold mines like this, we get all our raw materials in, we get our money out. It's a fine place to do business. Talking more specifically, one of the key issues that we have addressed quite head-on is indigenization requirements. So Zimbabwe does have legislation that requires local Zimbabweans to own 51% of all businesses. We are, to our knowledge, the only publicly listed gold company to comply with that legislation. So we own 49% of the Blanket mine, and we have 4 other partners who are Zimbabwean partners. So we have our workers who own 10% of the business. We have the Gwanda community, which is the nearest town where we operate, also own 10% of the business. A group of Zimbabwean businessmen own 15%, and then the Zimbabwean government owns 16%. So that takes them all to 51%. So importantly, with the workers and the local community, there's a lot of skin in the game for the local people, and we believe that gives us a tremendous amount of political goodwill, not only within the community in which we operate, but in the wider country. Also, very importantly, is although the 51% ownership by local Zimbabweans was facilitated by a loan from us to our Zimbabwean partners, which is repaid through the dividends that they would otherwise receive. So although we only own 49% of the asset, we get more than 49% of the cash flows until such time as those loans are repaid. So the actual structure is a bit more complex, but the simplest way conceptually to think about Caledonia is we own 49% of the Blanket Gold Mine, and we have a $30 million loan to our local partners, which is repaid out of our rights to their dividends. Depending on the gold price, that loan is repaid somewhere between 2022 and 2023. So until that time, we probably will collect about 80% of the cash flows from this mine, and after that time, we'll collect 49%, and we'll continue as a joint venture partner. All of the numbers you see here are on a consolidated basis, so they all represent 100%. If you think about it, so the next 5 years we get 80% of those numbers, and then after that we get 49% of those numbers. We still think they are quite compelling. Economically, things are very tough in Zim. Since the hyperinflation that dollarized the economy, things are very difficult, but somewhat paradoxically, this gives tremendous importance to the gold mining industry. We're one of the few generators of foreign exchange in the country. The government are acutely aware of that. And we do get preferential treatment in terms of managing foreign exchange remittances, getting capital equipment in and out of the country, etc. Without the gold mining and tobacco mining industry, Zimbabwe would not have any of the dollars they need to run the economy. So it helps being a gold miner and being a foreign exchange generator. Also, the government's been incredibly supportive. There is, as of last year, we've reported for the first time last year, an export credit incentive that they've been paying. So whilst there's a 5% royalty in the country, there's a 3.5% export credit incentive, which effectively puts the effective government royalty at somewhere near about 1.5%. So probably one of the lowest royalty regimes in Africa for gold mining. There are exchange controls, but they are manageable. As I say, we pay a dividend. We're a single asset company. We've owned this mine for 10 years, and my salary is paid essentially by the profits of that mine that come in and out of the country as we source raw materials and equipment, and as we repatriate dividends out of the country. So this is our capital structure. We're relatively tightly held with just below 53 million shares in issue. We actually, if any of you saw a press release, we announced this week a consolidation of shares, a 5-to-1 consolidation as part of the New York listing. It's a technicality for various reasons in terms of the funds we're targeting in America. It doesn't fundamentally change the underlying structure of the business, but that number will change as the consolidation is hopefully approved by shareholders. Our largest shareholder is a company called Allan Gray. They're one of a South African fund manager. This number is a little out of date. That we just announced this afternoon. They notified us they now own about 18% of the business, and then management and directors own 2%. That 2% might seem a little low. I would comment that whilst we only own 2% as a management team, some of the historical reasons for that are the fact that a lot of our management team are based in South Africa, and there is exchange controls in South Africa which prevent people from repatriating funds out of the country to invest personally. So that's prohibited some of our management from buying shares. We do have a long-term incentive scheme, which is essentially a cash-settled share-based scheme. So a very big part of my remuneration and my colleagues depends quite heavily on the share price, although it is non-dilutive and settles in 2019 based on the share price. So we feel we have a lot of skin in the game, and we're very closely aligned with shareholders, although in a non-dilutive share scheme. This is our reserves and resources. The number that you care about is the 2016 number. We're sitting on just under 1.3 million ounces of gold in total. About half of that is measured and indicated, and about the other half is inferred. So that gives us about 10 years mine life in this business. The important thing, though, to draw your attention to is this is a track record over time. So we've got a very good track record of replacing depleted ounces over time. Over this period, we've probably mined about 250,000 ounces from this asset, and yet we've still been able to grow the resource base. The mine is 100 years old, and it's never at any stage in its life had a 100-year mine life. So whilst we have a 10-year life at the moment, we certainly don't feel resource constrained as a business. This is a vertical ore body. These deposits, for those of you who know Zimbabwean greenstone geology, the deposits are not like you find in the South African tabular ore bodies, where the gold goes in about a meter thick and flat in every direction, very, very deep under the earth. These things are outcropping at surface and just keep going deeper and deeper and deeper. And for the last 100 years, we've been tracking this thing. The mine's been tracking and following the gold ore deeper and deeper into the earth. It is logistically difficult and prohibitively expensive to drill from surface to any meaningful depth. You can only really drill about 200 meters below you. So there is always going to be this element of rolling, extending the mine life. As you get deeper, you can then continue to drill deeper and deeper below you. We're currently at a depth of 750 meters. We've drilled about 200 meters below us, so we have a good understanding of the resource body 200 meters below us. Bear in mind, it took us 100 years to get to 750 meters. We're producing at a much higher rate now, so it's not going to be linear the way down. But our neighbors are operating at a depth of 1.5 kilometers, and there's no guarantee that we'll get to that depth. But if we're as lucky as they are, and the gold keeps going to 1.5 kilometers, we will certainly be out for a lot longer than 10 years. So Yeah, we don't feel resource constrained as a business, and we think our track record in terms of this replacement speaks for itself. So I mentioned we're planning to grow production to 80,000 ounces. So this is from a base of 40,000 ounces back in 2015. So essentially we've been in the process of doubling production over the last few years. And that plan, we've been investing quite heavily. This is the last major capex year for that investment. And then there's essentially a ramping up process to get to those 80,000 ounces. The investment plan really involves three key components. Firstly, investing in adequate underground development so you can get to the areas of rock you need to get to mine efficiently. These type of mines don't die because they run out of gold. They die because you don't fix the roof while the sun is shining, because you don't invest adequately in the underground infrastructure to make sure you can keep following the gold, to get to the to make sure that you have sufficient tunneling infrastructure to be able to manage the mine effectively. So that's the first component of the project. Secondly, a small shaft which is called number 6 Winds, which I'll show you later, which takes us slightly deeper into the ore body. A little bit of a band-aid gets us to some deeper levels of deposit. But thirdly, and most importantly, a brand new central shaft. So we're building this is probably one of the biggest mining projects in Zimbabwe at the moment. We're building a shaft from surface all the way down to 1,000 meters. It will set the mine up for many years to come, and will essentially be a brand new mine under the existing mine. So if you can imagine how mines grow organically over time, you don't get to design them from a clean slate of paper and say, this is how I would build this mine if I were doing it from scratch. You tend to just always be bolting things onto your existing infrastructure. And that's the legacy we've been sitting with at Blanket. And we're now in the process of taking the plunge and investing for the future. This is the third year of a 3-year capex program, and I'll talk you through that now. So this is a cross-section of the ore body. So we're looking at essentially probably 3 kilometers across, and about total depth that goes down to about 1.2 kilometers deep. This is the Blanket ore body. Apologies for the graphics; they're better quality on our website, but this is the Blanket ore body, the gold-bearing rock. You can see the grey bits are the mined-out areas, and there's a color code scale there below. This is 750 meters. So that's historically where our infrastructure has been constrained in the mine. That's where we grew from surface. That is our current development infrastructure there. So the green infrastructure, that's number 4 shaft. All of our materials move, all of the rock moves along 4 shaft and along these development tunnels here. That's Jethro shaft where our men go down. You can see it's all the way over on the right. And that is number 6 Winds, which is the shaft I mentioned, which gets us slightly deeper into these indicated resources down here. This is probably slightly higher grade area, but to get us into the deeper areas of the mine. It's the only place in the mine at the moment where we have a shaft taking us to deepen that level. So if you can imagine, our men come down here and then have to walk 2 kilometers to mine over here and to mine at these in this section here, or go slightly deeper and mine over here. This is not how you would build a mine if you were building it from scratch, right? The only reason everything's over far on the right there is because that's where the first gold was discovered, and then as often happens with these things, they tend to feed and find additional satellite deposits further and process those in the same area. This is our inferred resources, which I mentioned. We've got 600,000 ounces of inferred resource, which is not in the mine plan. So those shaded areas there, you can't really see them too clearly, but that's the inferred resources, which indicate that the gold keeps going. And these are our exploration targets, which we've put drill holes through here, but we don't have enough holes to get a resource. We don't have, you can't drill to depth until you actually get down there, bearing in mind that you can only really drill about 200 meters below where your current infrastructure limit is. So we have every reason to think the gold keeps going, and we should be extracting that gold for many years to come. That is the new central shaft. Now, it comes down right in the middle of these 2 main legs, which are AR South and AR Main, which are very, very wide, about sort of 3.8 gram rock, but in some cases as wide as this room, so a large scale, almost a bulk underground mining operation, and it keeps going pretty deep. This is about 70% of our future production comes from these areas here. So the shaft is going right from surface all the way down. It's going to go all the way to 1 kilometer, and it's going to then have 2 development levels below it, which will set us up to extract gold in these deeper areas. This is going to get people to the mine within 15 minutes. So they'll be basically from surface all the way. They'll be at the work face within 15 minutes. You can mine from 2 sides, obviously, which makes it more efficient. And we don't have to have any of this haulage infrastructure. This thing hoists men, materials, equipment, and rock all at once. So we're very excited about this. We think it's going to set us up for many years to come. This is what it means for production. So this is our historic production. Since when we acquired the mine, that's last year 50,000 ounces. This year we'll get somewhere around 55. We don't have formal guidance in between there, but we'll probably see a roughly linear growth to 80,000 ounces. And that, as we produce more and more ounces, we'll see the fixed cost components of the mine spread over more and more ounces, which means we'll expect to see the cost decline to somewhere between $700 and $800 an ounce on an all-in sustaining basis. So this is what it means for earnings effectively. You can start doing the maths for yourselves, but we're going to be an 80,000 ounce a year producer at an operating margin of between $400 and $500 an ounce, depending on at $1,200 gold. That generates somewhere between $30 and $40 million of EBITDA. Our market cap is $65 million. We've got $11 million in the bank, so we kind of got an enterprise value of $55 million. And by 2021, we'll be generating on a consolidated basis $40 million of EBITDA. After tax and minority interests, that leads to earnings of anywhere between 35 and 45 cents, with a share price currently of $1.20, and getting paid a 4% dividend while you wait. So we think the numbers are pretty compelling. Last year we did 21.4 cents at 50,000 ounces. When we grow that to 80,000 ounces, we think this presents potentially very attractive returns. And like I say, we do. So we're sitting on a PE at the moment, trading PE of 5.7, forward PE depending on your assumptions on the gold price, and a 4% dividend while you wait for that. This is my favorite chart of the lot. So this is the dark gray here is our capital expenditure over the years. So this is the last 2 years. We've been investing very heavily in this mine. All of this funded from internal cash flow or internal cash resources. So last year we generated $23 million. We divvied out $3 million. That divvy, 5.5 cents a share, costs us about $3 million a year to give back to shareholders. And we invested 20. So the cash balance last year was roughly flat. This year we're likely to pay a bit more tax. Cash probably won't grow again this year. We're still investing $18 million this year. But this capex profile drops off quite dramatically from here, and the money generated goes the other way. So next year we anticipate generating probably 25, and we'll invest 8. So suddenly there's a spare, and this is the numbers start getting the spare money that we could either distribute to shareholders or potentially invest for growth. So if you consider now that our dividend costs us $3 million a year to pay a yield of 4.5%, we see us being able to grow this dividend very substantially over time, and we're all heavily incentivized to do that. So the default position is to give this money back to shareholders. If we do find an asset, it's got to result in a bigger amount of cash over those years, and so we have a very high hurdle to clear. We are looking for things to invest in, but there's nothing wrong with just giving the money back to shareholders. So this is our dividend yield. So the industry has been yields have grown. So there's a few. We're not quite the highest yield in the sector. This yield used to be much higher. It used to be up to about 8%, but the share price has risen quite dramatically since then. So the yield has dropped in the way you want to see your yield drop. I'll just draw your attention to the payout ratio. So our dividend is 4 times covered at the moment, and if you see how that cash pile or that cash flow forecast is going to grow, we feel quite confident about the future. So to wrap up, I've mentioned we have a good dividend yield, which is very well covered, and a very strong growth profile. So you get paid while you wait for the growth, and we think 4.5% is not bad. We have a high margin operation. So last year we were 912. This year, even if we get to the top end of our guidance of 850, that gives us a margin of safety to survive at essentially any conceivable gold price, as far as we see it. We have a growth program which is fully funded internally to get to the 80,000 ounces, and also importantly, we are looking at other assets and seeing if there are attractive things to deploy capital in a year or two's time. we're acutely aware that our industry has a very bad reputation of spending the profits of a good mine on a bad mine. And so we have a great mine here, which has been a fantastic investment for us, and we really don't want to be those guys who blew their brains out in a foolish acquisition. So hopefully we certainly the intention is to remain disciplined and to measure anything against the hurdle that we have here. And lastly, we have a strong management team. We have our chief exec, Steve, was born and grew up in Zimbabwe, based in South Africa, and so we have a strong operating base from South Africa who can manage the situation in country, and then very good people on the mine. We think our results speak for themselves. So that's all we have. I don't know if there's any questions.
Any questions, anybody? Any hands going up? One at the very back.
Would you consider investing in Zambia by any chance?
Yes, we would. We used to have a project in Zambia called Nama, which was a cobalt project, which we disposed of some time ago. So we would look at, we'd like to stay in gold, importantly, so that we think that's a natural fit for us as a business. Looking at countries without the asset is always difficult. People often say, I bet you no one would have said, yeah, I'll invest in Eritrea, but then someone shows you Bisha and you go, yeah, okay, I'll have a look at that because it's such good quality. So we like ideally countries in sub-Saharan Africa that we can get to relatively closely, that we can speak the same language as government and have an operating track record. So yes, short answer, absolutely, we'd look at it. But it depends. We're guided first by where the gold is, rather than by the country geography. It's more about the individual asset itself.
Sorry, who are your major shareholders apart from the government?
Just 1 second, just wait for the microphone next.
Sorry, who are your major shareholders apart from the government, your workers?
Okay. So Caledonia shareholders, the government, workers, Gwanda community, and Zimbabwean businessmen own a share in the Blanket mine. And we own a share in the Blanket mine. So Caledonia is 100% owned by our shareholders. We own 49% of the Blanket mine, which is essentially a partnership with our local Zimbabwean partners.
So you have no any other corporate backing?
Well, in terms of
partnership or somebody partner with?
No, we don't. We own and operate the Blanket mine, and we have additional partners who are shareholders with us in the mine. In terms of Caledonia shareholders, Alan Gray are the largest shareholder. They're up to about 18% now. I think Miton have a bit, but they're not notifiable above the 3% limit. But we know they own some. There's a few other funds in London, but nobody above the 3% threshold from an ownership point of view. If that answers your question.
Yes.
Okay.
And Alan Gray have been buying the market, presumably.
They've been buying on market. They bought their whole position on market from zero, and they keep buying, and we welcome them as a supportive shareholder.
And when Blanket, is it 2023? You said it goes back?
It depends on the gold price, but it
when they do their payback to you.
Yes.
How does it look then in terms of the profitability of the mine? Because obviously it's going to be a profitable mine, but you're going to have to give some of that profit to the local partner before it comes to Caledonia, I presume, won't you?
Well, they'll get their 51% share that they're entitled to after the loan's been repaid. So right now, if a dividend is declared from the mine to us, not our dividend to our shareholders, but from the mine to us, we get the 49% we're entitled to because of our 49% shareholding, and then we get 80% of their dividend until such time as that loan is repaid. Once the loan's repaid, they get their dividend, and it's theirs to do with.
Come 2023, you won't have their 80% of their dividend. That will go to that.
Correct. So we will see
the decline in cash flow.
The cash flow. There is this wall of cash that comes in the next 5 years, which we're quite happy with, right? It's nice to have. It's a nice problem to have. But yes, post the repayment of those loans, long term, we will get 49% of the cash that comes out of this business. But for the next 5 years, we get close to 80%.
And as an old mine, is there opportunity to sort of tailings and treatment of tailings, reprocessing, or not? Or is it just
no, for the simple reason that it's been done already. So there was lots of higher grade tailings which built up over 100 years. We have our cyanide capacity on site for the CIL circuit is about 3 times the capacity of the rest of the plant because we were previously running a tailings operation, which is nice. The nice situation is then we could expand the plant without having to grow the cyanide capacity. We just need another mill and some more crushers, and it would be fairly easy to expand. But there isn't a tailings opportunity at the moment.
Not sufficient resource there to do that?
No, there isn't.
Just a simple question. Future view on gold price? I noticed you're about 1,200 on the numbers. Is that conservative, or do you think that's fair?
So I'm very bullish gold, but I'm also humbled by being wrong for 5 years. So we dig it up, right? And we're good at digging it up. There's smarter people than us who don't know what's going to happen to the gold price. So I'm not dodging your question. My opinion is that at some point the monetary chickens are going to come home to roost, and we are not going to be living in a world free of consequence from essentially 8-9 years of very, very unconventional monetary policy. And I think if history is any guide, we are likely to see the Federal Reserve and central bankers around the world surprised by the unintended consequences of their policies. And ultimately, that I think is very, very bullish for gold. But you know, the challenge is you know, I've had this opinion for 5 years, so it's a tricky one. But yeah, certainly we do see from some of our shareholders just starting to say, well, if I can get this sort of dividend and this sort of growth in a gold stock at $1,200 gold, if I'm right about the gold price, then those numbers get even more exciting. I mean, on the gold question, sorry, just to finish off the answer, I have a $100 trillion Zim note, which when we inherited the mine when inflation was 30,000% or something like that, and it went to 100 million%. And then, I mean, we joke about it now, but at the time it was a tragedy. The workers were going hungry, and we had to bus in food to keep them. But that's. I grew up in sub-Saharan Africa. I've seen what happens when governments borrow money they can't pay back and print the difference, and it doesn't end well.
Any other questions?
So you said you've got a very good relationship with the government at the moment. I was just wondering how you would how you're proposing to manage that if leadership were to change, or.
I think when I say we have very good relations, we have a healthy working relationship with the Zimbabwean government, I think, and the relationship is exactly as it should be, I think, as appropriate for a large investor and operator in the country. We think that whatever happens in the leadership succession planning, we don't comment publicly on it because to be honest, we really don't know. We think that there are sufficient structures within the ruling political party to choose a successor, and I think that there's likely to be a warming of relations internationally to Zimbabwe, as depending on who that successor may be. But I suppose it's difficult to speculate on the politics, nor would it be appropriate, except to say that we're not concerned about succession.
I've got a couple of comments really. You've got quite a low PE ratio, haven't you?
We do.
Very low for the marketplace, very low, but a steady dividend yield. You're going to a third country for listing. Is your principal listing on the TSX?
So we already have 3 listings. So we have the AIM, we have TSX, and then we have it's an OTC listing in the US. So we're already an SEC registered company. We already bear all of the regulatory burden of filing the necessary reporting to be listed on an exchange that, what we've been told in the DD that we've done, is many of the US funds that we'd like to market to can't invest on those exchanges. So it's a case of moving to, we already bear the regulatory burden. It's a case of moving to an exchange where we think there's a better pool of liquidity, and hopefully to reflect that will be reflected in.
Have you got more liquidity on TSX or AIM at the moment?
No, AIM is better. We've got slightly more liquidity on AIM at the moment.
So there's a regular turnover of shares.
Yeah, and liquidity is poor.
Hence you're here.
Yeah, exactly. Liquidity is not good. we would
try and improve that.
Yeah, which means we need, ideally, we need a combination of a few reputable institutions, and we're working hard to achieve that. And I think we've got a few quality holders under the 3% level, and then we need more retail interest as well.